Disney reported mixed results for its third quarter after the bell on Wednesday, missing expectations for revenue but beating on earnings per share. Disney stock higher today after initially dipping in after-hours trading. Joining us now, we've got Matthew Thornton, who is the Truist Securities Analyst. Matthew, great to have you here with us this morning. How should investors look at Disney stock after this report?
Look, I think we got some positive incremental takeaways here. I mean, the focus for this company right now is clearly profit and cash flow over revenue and subscriber growth, at least for the short term. And if you look at what we got yesterday in the streaming business, profit was better, particularly on pricing. Subs were weaker, but I think that should be and probably was expected. The linear TV business continues to struggle from a secular perspective, but again, I don't think that's new. The box office remains challenging and lumpy. Again, I don't think that's new. And in the parks businesses, look, I think you've got some puts and takes. International strong, domestic softening from really, really tough comparisons year over year. But I think the probably more important incrementals here are, the company talked about raising price in the streaming business probably a little more aggressively than folks expected. They talked about cracking down on password sharing, very similar to what Netflix has done. They introduced a new sports betting partnership yesterday, and they said that their cost actions are actually running ahead of plan. So they're going to do better than that $5.5 billion. So I think if you kind of wrap that all up, profit numbers are probably stable to maybe even rising coming out of this earnings results.
I want to focus in, Matthew, it's Julie here, on the streaming business in particular. And you mentioned that they're sort of following the heels of Netflix here in terms of talking about password sharing crackdown, although it sounds like they haven't done it quite yet, raising pricing, offering more tiers. It sort of feels like after Netflix lost its mojo, it feels like it's gotten it back and then some. And then now there's sort of an also-ran situation where the other streamers are maybe running to catch up with Netflix at this point. Is that your impression, and are they going to be able to catch up?
I think it's a maturation of the streaming market. I think we've had the last 4 or 5 years of pure focus on subscriber growth and gaining scale, and I think we are now getting to a point where penetration rates are higher, where there's a much more balanced approach to monetization and profitability. And so I think a lot of these services, Disney included, are really thinking through what are the right price points, what is the right tiering structure, how do we lay in advertising in an accretive way, because subscriber growth isn't going to be at the levels that we've seen in prior years because the law of large numbers are starting to set in here. So I think it's a very natural maturation process across the streaming landscape.
And so this is still a company as well that has a lot of kind of changeover that's taking place at this time, either in strategy that's enacted or just in terms of what the experience for a myriad of consumers that they deal with looks like as well. But what's caught investors' attention is whether or not there could be parts of this company that are eventually sold off. Do you see that coming to fruition? Is there anything that you heard on the call that gives you the inclination to believe that we could be looking at a far different Disney or part of a Disney that gets sold off to some other company over the next, say, 12 months to 18 months?
I think what's pretty clear here is there's a lot of optionality, and I think CEO Bob Iger made that point pretty clear. If you look at kind of what the core is of this company, it really is their tried and true owned and operated brands. So the Disney brands, the Marvel brands, the Star Wars brands, the Pixar brands, which of course extend to their portfolio of parks and cruises and experiences. That is the core of this company. That is the growth driver. That is the highest margin, highest value piece of this company. I think where the optionality really lies is around their linear networks business and, of course, ESPN and the sports ecosystem. I think they were pretty clear that within ESPN they are preparing for a transition to a streaming world. They are looking at strategic partners that can help them on the content or distribution side. And so what I think that tells you is they are hard at work, pen and paper, trying to figure out where they want to take this business. And it could look very different. And when you think about the legacy networks business, so, if you think about ABC and FX and some of the linear channels, I think, again, all cards are on the table here, and that could include a sale or spinoff of those assets. So I think the point here, we don't want to get over our skis, but the point here is there's a lot of optionality, a lot of work being done, a lot of conversations being had.
Matthew, bottom line, I know you're buying the stock, but given what we heard specifically from the company on the call and in the report, would you be buying that stock today on what you heard?
Look, I think the setup here for the stock is better today than it was yesterday. And then the reason I say that is, again, I think the results that we saw yesterday were better than feared. I think profit numbers are probably stable to going up coming out of this print. We have an investor day, a 3-day investor event that they'll host next month where we'll get more incremental color. And I think sentiment in general, could swing in a couple different areas. If you think about the ongoing strikes, I think sentiment is clearly, pinned to negative there. If you think about box office choppiness, those are things that can go back the other way pretty quickly. So we actually think the setup today is better than it was 24 hours ago.
And then just one quick final question on the parks, and specifically on Disney World in Florida. What's going on there? Like, what's really going on there? And are we going to see a rebound in the traffic there?
I think it's a combination of several things. I think you've got really tough comparables. Remember, they had their 50th anniversary promotions and events last year. You're starting to anniversary those. I think, when you think about 2022 into 2023, I think there was a lot of catch-up vacationing because of what happened during the pandemic, and that's starting to moderate and normalize here. And so I think it's a law of large numbers and a lot of normalizing of demand and tough comparables that you're seeing in Walt Disney World. I think conversely, if you look at perhaps Disneyland, but certainly more so international parks where the pandemic's extended a little bit longer, so we're still much earlier in that catch-up phase. Those are still outperforming and exceeding expectations. Cruise lines are another great example there. So I think they're in different parts of the curve getting back to kind of a normalization.